Assalamu alaikum. We are studying the chapter number 2, which is about financial statement, cash flow, and taxes. And this chapter is giving information about which is financial information about companies. And this information is given to the shareholders so that shareholders make optimal decision and they make a right decision about investment. Because first of all, whenever they make decision for investment, they see that how company is performing and how is the value of the company. Is this company able to pay back dividends? So all of these information are determined and analyzed with the help of the financial statements. So before coming towards the some information which are the components of the financial statements, like balance sheet, income statement, and statement of cash flows, these all components are included in the financial statements. We will first know that what is the financial statement. These are the pieces of paper with numbers written on them, but it is important to also think about the real assets that underlie the numbers. So it means that in this we are representing the value of assets. Either they are short-term assets or long-term assets, and either they are telling us about liabilities or shareholder owners equity, and about the cash flow statement. So here, with every assets have values. So values are associated with the assets, and all of these information are given in the balance sheet, income statement, and the statement of cash flows. So financial statement is actually giving us information about how company is performing. Is this company able to pay back dividends to the shareholders? Because shareholder will make their profound investment in companies, so therefore these shareholders, they want to know about companies financial performance. So for that purpose, financial statements are made. And now we are giving a history of accounting. So history of accounting is telling us about the era of self sufficiency, evaluation of barter system, and then the rise of banking and credit, the modern industrial requirements, translation of physical reality into numbers. So the era of self efficiency means that before starting with the business, trading system where usually trading exchange of goods were not taking place. So here these individuals, they used to earn for themselves, like in the form of shelter, in the form of food or water. So these individuals, they were finding food for themselves only to support their families. So families, here it is, these are written in the form of points, that families were self-contained. They prepare themselves for own clothes. They struggle for the food and build their own shelters, and there was no trade, there was no need for accounting. So it shows a very simple era in which individuals just struggle for themselves, for their families, to find a food and clothes, and to find a shelter where they can live. But there was no such concept of trading system and accounting here. But in next, further on, when specialization, people used to specialize in different areas, in multiple areas. So for that system, barter system, it has been originated, and it's written in this slide that people begin to specialize. For example, one person made pots and another made clothing. Specialization forced trading, and this was simple barter system. As trade moved beyond local villages, money like clamshells was introduced to standardized value. So so it means that people who were specialized in different areas, like making clay pots and or manufacturing, or they struggle for making clothes. So in that case, trading was very important for them, because in that for that purpose, they will be able to fulfill their own needs as well. So in that era, trading take place, and with the help of the trading, they were able to have improvement in their lifestyle. So money was introduced in that era, which is the specialization and the birth of barter system. So money was in the form of shells, and here the picture that shows that has been shown in 1742, which is a 1742 picture drawing of shells of the money. So these shells were used for the barter system, and these shells were used to exchange or to sell, to do trading and to sell goods, in which they were specialized, in which they were using their skills and capabilities to sell clothing or food. It's not only about non-living things, like they can sell some living things, like for example, they have their own poultry farms, they sell clothing, and so for that system, then a barter system was important. And when the rise of the banking and credit system originates, so in that case, these individuals, they were able to hire some individuals for banking purposes, for credit purpose, for trading purposes. For example, the rise of banking and credit means that master craftsmen open factories and hired workers. Wealthy merchants begin lending their profits to these entrepreneurs. Early lenders could physically walk into a shop, count the pots, and see if the borrower could pay them back. It means that here the rise of banking and credit system originates, which means, for example, if an individual is in need of a money, then that individual mm, will request the other person who has whose financial position is good. And if that person, which is a person B, that person B will see that whether person A is able to pay back money. So for them, for that purpose, the person B who is financially stable will see that whether person A is able to pay back money. So that person will see whole financial information, the background of that person A, and then after deciding all of these financial information, after looking up all financial information, person B will decide to give some money on credit to the person A. So in this way, credit system has originated. Then with the help of the banking, like banks, they also play their important role. They have a very integral role in the society. So when a company who are in the need of a money, they will request banking firms to pay them or to lend them a particular amount of money to the companies who are in need of who are in financial need. So for these banking institutes will give their financial services to them, and then these companies are able to perform a good and have a good economical position. Here in the next slide, it's written that as trade expanded to distant lands, ships, wagons, and mines, lenders could no longer lenders could no longer personally inspect the assets. They need a summary of what the borrower owned. This was the birth of the financial statement. So this actually means that companies who are in need of money, then they will request lenders who are creditors, they will give some amount of money on credit to the debtors, and these debtors will use their money, but before that they will do some inspection, and they will personally, as it's written, that they will personally inspect the assets. So they will see that whether that company is able to pay back money later to the lenders. So for that purpose, financial statement originated. And now the next component is the modern industrial requirements. There are three specific groups demanded standardized accounting: investors slash lenders, managers, and governments. So these are the components. These are the working principles. They perform their important role in making an industrialized environment. For example, the first one is investor or a lender. Lenders are those who are investors, or they invest money. We can also say that they not only invest money, but they also give money on credit. to the companies who want to make investment, who want to give who want to give a firm growth, and they want to invest some specific projects for them. For that purpose, they request for money from lenders and investors. So these lenders are those who lend money to the companies who are in need of financial support. So the next component is managers. So managers, they will look after the whole organization, whether how much of the money or how much percentage of the money these companies must pay back, must give as a as a loan to other company who are in financial need. Or for example, if a company itself is in a financial need or a financial support, so what they will do, they will request other companies to help them, or other banks to help to support them in some specific projects in which they want to do investment. So managers, they play important role, because they will see that how much of the assets we have or inventory we have, so, with the help of which we will be able to pay back money to the lenders. And then we have government support. Then government also help companies to grow themselves, to increase their firm value, and to perform economically and individually itself, to perform better in the in the specific industry in which they are working. So like for example, in the form of T-bills, which are marketable securities, they are the government securities which are issued by the government, but they are these are the marketable securities which are issued by the corporation, but these are actually the government securities which are provided by the companies, so that the companies are able to raise fund. So T-bills are the government debt security that matures less than 1 year, and they're issued by government. So in this way, government can help companies to do their further investment, to have a good projects in which they can make good investment. Okay, then we have the translation problem. Accounting is a translation of physical reality into number, which consist of the two further components like historical cost versus reality and hidden risk. Historical cost versus reality, it means that for example, an asset that we purchase it on at the original cost. So the original cost, historical cost means the original cost of an asset on which we purchase, or the amount of the money that we make investment on an asset to acquire. So that is that original amount that a company invests to acquire an asset is the historical cost, and it is not affected by any market fluctuation, or inflation. So these are the historical cost versus reality, means that there are some inflation effect is also included in that price. For example, a price that fluctuation comes in a price, so that is the because of the inflation factor included in it. So or market effect is also included in the value of an asset. So this is the reality. But what is the historical cost? Historical cost is different from the reality, which is the historical cost, means that that is the original cost, which is the cost of an asset, on which or the amount of an asset that we have or a company has paid to acquire that asset, and whose value is not, whose price, whose value is not affected by any external factor like a market, and inflation factors. And then we have reality. In reality, it means that the assets that we have purchased, but the price of an asset is affected by the market factors, and like inflation factor, which is the economical factor. So, for example, if a stock is traded in the market, then there is the hidden risk involved in individual stock, or in the collection of the stock in a portfolio, like market risk. And but with the help of the portfolio, these risks are mitigated or reduced. So these are the hidden risks that causes fluctuation in the prices. Either they are the stock prices or a commodity prices, which is sold in a physical marketplace, and stock prices, these are traded in the exchange marketplaces where stocks and bonds are traded. Then we have financial statements and reports. So these are the financial statements are actually annual reports, a report issued annually by a corporation to its stockholders. So shareholders, they make investment, they want to see how company is performing, either company is able to pay back the return to the shareholders for the investment they made. So for that purpose, they see annual reports. It contains basic financial statements, management analysis of the past year operations. They see that how management is performing in its way. Are they able to fulfill their are they able to fulfill their promise, and their promises to increase the firm value, because when firm values increases, the firm growth is also increases, as we have stated in the chapter number 1. um, because with the help of the increase or firm value maximization, these managers are able to give returns to the shareholders, and they are able to have a to able to fulfill the interest of the shareholders, which means that the interest of the when interest of the shareholders align with the interest of the management, then it gives a good outcome, which means that management are working according to the shareholders interest, and there is no agency problem exist. So as managers are giving priorities to the shareholders interest, and they are also working for themselves, so there is a alignment between management and shareholders. Then it means that it provides opinions about the firm's future prospects. And then these managers, they can also act as an agent, and they can provide some suggestion to the shareholders how to make an investment. So for that purpose, annual report is important for the companies to hold, and in which they give information about the financial information, and their financial statements are included. So there are the two types of information are given in this report. First, there is a verbal selection, which means that the uh, firm's operation, to see that how firm is operating in its past year, and how their past year performance can help in the future operations. So this is the first verbal selection, uh, through which the shareholders, which is also one of the important information given to the shareholders, and in that basis they are able to know to make an investment in that specific company or not. So the second is the annual report presents four basic financial statements: the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. These are the information which are presented in the annual report. First of all, information that is the verbal selection, and then we have a information in the form of the financial statement, which is the balance sheet, income statement, and statement of retained earning, and the statement of cash flows. So here was first of all we are discussing about the balance sheet. What is balance sheet? It's one of the component of the annual report, and it explains us about the financial position at a specific point in time. So it is a statement, or it is a statement of the firm's financial position at a specific point in time. That how, for example, for a year, that is here in the table 2.1, it shows that for the allied food products, December 31 balance sheet, and this is the December 31 balance sheet, and for this year, they are representing that for the year 2000, and on that 2001, and on the basis of the past year performance, companies will able to know that how they are performing, or are they able to pay back returns to the shareholders. So for that purpose, balance sheet is made, and it is the statement which shows the financial position of the firm in a specific point in time. Like here the years are given, and that is the current year and the previous year. So with the help of the previous year, we are able to determine how company is performing in the current year. So for that current year, balance sheet is made, and these are the table 2.1 shows that the firm assets, while the right hand side shows the liabilities. On the left side, it is these are the assets written, which are the current assets and non-current assets or long-term assets, and mm, on the left side it's the assets, which is the long-term short-term assets and the long-term assets. Then on the right hand side, these are the liabilities and equity, liabilities and equities which are claim against these assets. And then we have these assets are listed in order of their liquidity or the length of the time it typically takes to convert them into cash. So here in the balance sheet, if we see, we have on the left side assets, then on the right side liquidity and shareholder owner equity. Then in the assets we have two components, two divisions, that first of all short term assets, and then we have a long term assets. In the short term assets we have cash and marketable securities, then account receivables and inventories. We get total current assets, and then for the long term assets we have net plant and equipment, and finally we get total assets. So in the liability side we have accounts payable, we that is the current liability and non-current liability or long-term liability, and then we get total liability, and after that we have a total liabilities and owner's equity. Okay, so here if we come to the left side, the asset side, which is on the left side, it has short-term asset which is called cash and marketable securities. These are the marketable securities are T-bills, like T-bills and commercial paper and certificate of deposit. So these are the marketable securities, and which are payback or which matures in a short period of a time, and so therefore we write it with the cash. Therefore, we say it as a cash and marketable securities. So then we have account receivables. Okay, T-bills are, as I told you, that T-bills are government bonds. They are issued by the government, and they are matured in for a less than 1 year. And so these are the short-term assets. And then we have commercial paper. They are issued by the corporation. Certificate of deposits means that the deposit or made by corporation in banks, and for it defines a specific time, and after completing that specific time or fixed time, then principal amount plus interest is paid. So in a lump sum amount, the final amount is given to the company by the banks. So these are the certificate CDs, which is the certificate of deposits. And then we have account receivable. Accounts receivable means that, for example, if I for example, if a company they give a commodity to other company for a short period of time, for a week, 2 weeks or 3 weeks, or for 1 month or 2 months, that is within a year, then they will receive money from other company to whom they have lent their commodity. So that is the account receivable. So account receivable means that the commodity that a company has given in the form of a debt to other company, and then within a month that company receive a money for the commodity that has been given to that company who was in a need of a commodity. So within paying back of that money within a month or within a year, so that is called account receivable. Then we have inventories. Inventories are the stocks. They are they are saved with the companies. They are the physical commodities which is used for the production purpose, and they are saved with the factories and companies for production purpose. Then we have a total current assets. Then and in the long term assets, it's include net plant and equipment, which means all the raw materials, the machineries, land. So these are machineries, land, and building. They are included in the long term assets. Now, on the right side, we have liabilities and owner equity, accounts payable. Accounts payable means that a company's obligation to pay off a short term obligation to its creditor. It means that, for example, if a company A borrowed a commodity or any material from a company B, then the company A is mandatory to pay or obliged to pay back that commodity to the creditor. Then we have notes payable. So, notes payable is the promissory note where borrowers record their written promises to repay lenders. And then we have accruals. Accrual means that they are representing those expenses that company has to pay and that has not yet been paid. So this is all representing total current liabilities. Then we have long-term bonds.